Unfortunately, when you're in retirement and you want your finances to be easy and everything smooth, there is a common tax surprise that is very unfortunate. It's the surprise you don't want that is related to your pension and how withholdings are structured on your pensions. What's the problem? What's the root? And how do you fix it? I've got that and more coming up. If you have a pension in retirement, my guess is you have experienced this problem. And by the way, if you're watching this and you haven't yet retired, but you've got a pension, or maybe are just looking at, well, yeah, how am I going to structure my income in retirement? This content's for you because this surprise, while rooted in pensions and connected to pensions, it actually can manifest itself in a few other ways as well. And if you had a pension and you haven't had this surprise, it's very likely that you just preemptively implemented one of the solutions that, avoids this surprise without even knowing it. What's that surprise? Under withholding on that pension income. See, pension income is ordinary income. It's taxable income. So as you earn it, it's going to land on your tax return. And yet, unlike wages, there is no uniform tax withholding system when it comes to your pension. And this is where I say, even if you don't have a pension, pay attention because there's no uniform withholding approach or strategy for IRA withdrawals, for your Social Security, for your other retirement income. Typically, there isn't a uniform tax withholding system, and therefore you could be walking right into a tax surprise. What is that tax surprise? It starts with, I owe a lot of money. It just recently, right before the tax deadline, we were helping an individual with their taxes, and sure enough, started a pension last year. Sure enough, without getting any advice or working through it with anyone, kind of stepped right into this trap and got the surprise. We had to deliver that she owed $2,500 on her taxes. That's the surprise problem number one. Problem number two is, if not corrected, she's going to have the same problem next year, but plus a tax penalty. Now, the tax penalty comes from not paying taxes on time. When are your taxes due? When you earn the income. Your taxes aren't actually due. The payments aren't actually due April 15. That's when your return is due. The taxes are due when you earned the income throughout the year. You need to have the right withholding, basically, is what the IRS is saying. Otherwise, we're going to penalize you. And if you don't have the right withholdings, you have to pay it in a different way. I'm going to get to the solutions here in just a second. And therefore, if you're going to owe on your taxes, you need to pay in at least 100% of what your tax bill was last year. And if so, you'll be in safe harbor. There won't be a penalty. Or if you have a high income, your income's over $150,000, you need to pay in 110% of last year's tax bill if you're going to owe and avoid a tax penalty. So I don't like the tax surprise of, oh my goodness, I wasn't prepared and I owe a lot of taxes. And I also want you to avoid the tax penalty. So what happens and how do you fix it? What happens when you've got a pension? Likely when you signed up for it, you checked a box when you were applying for it. When it came to tax withholdings, there's likely a spot for federal withholdings and a spot for state withholdings. And in that section for federal withholdings, your options are withhold at the default rate, withhold a specific percentage, or don't withhold. Those are typically, and it's not all of them have those three options, but most of them have those three options. And it's likely you just check the box that said withhold the default rate, right? You know my situation, you're going to withhold the right, or you know how much pension there is, withhold the right amount. Well, the amount to withhold for taxes is going to depend on not just your income from the pension, but all of your other income sources. How much you withdraw out of your IRA, whether you have any interest income, from dollars at the bank, whether there are capital gains, whether you're on Social Security and whether your Social Security is going to be taxable. All of that plays into your overall tax picture. And when you're selecting that box, when you're signing up for your pension, they don't see that full picture. Your certified financial planner does. Looking at all 6 areas of your financial life, they're the ones that are really in a great position to say, oh, no, make sure that you select this box, not this other one, and withhold 20% or 12% or 15% or whatever the number is. So how do you fix it? Well, there's a few different ways you can fix it. And step one would be to go back to your pension provider and fill out what's called a W-4P. So when you signed up for your pension, likely you just selected the box. But you could have also, or maybe instead, filled out a W-4P, which is an official withholding form for pensions. So if you didn't, or if you're looking to fix it, then you might, one way to fix it would be to fill out this form. You can see it here, and it looks a lot like the new W-4 system. Now, these aren't perfect. There's plenty of flaws with these as well. But in this, you can list out, here are my other income sources. So make sure you withhold appropriately based on all, my entire financial picture. The problem with these W-4Ps is they don't know how much other withholding is being done on those other sources of income. So it's possible they still under withhold, i.e. continuing to create this tax problem or tax surprise, or they very much over withhold. Now your take-home pay from your pension is significantly reduced, and then you get this huge refund out there at tax time. Both of those are problematic. But yeah, step one, you could solve the problem by filling out a new, or potentially for the first time, W-4P. Second option is to increase your tax withholding from other sources. So if you, in addition to your pension income, for this individual that we had to share this bad news with, she's still working part-time. And by the way, the part-time income, they're not withholding enough tax either. So one solution could just be, hey, listen, on your wages, have them increase your withholdings, withhold an extra $250 per pay or something like that. And that will help offset or cover the withholdings on the pension. You can do this if you've got IRA money coming in, or some other asset or some other income stream where you've got choice in your withholdings. You could increase your withholdings there. Third, and my least favorite, is you could pay quarterly tax estimates. Now, this is my least favorite because these are hard to remember, hard to know the amount, and yeah, can be frustrating and confusing. Why? Yeah, they're quarterly estimates, but they're not every quarter. The first one's due April 15, second one's due June 15, just 2 months later, then September 15, and then January 15. So you've got to remember that, and then the amounts can vary because if you withdrew more from your IRA or had more income, all of a sudden, now you've got more taxes that you need to pay, but you're still paying estimates based on last year, not this new information. And so it can be obsolete and can still lead to the tax surprise. And finally, option 4, solution number 4. This one we implement all the time, and that is a IRA 60-day withholding rollover strategy. Now, that's a lot of words there. What does this mean? So I told you to avoid an underpayment penalty. The IRS says you need to pay your taxes when you earn the income. And if you don't, then you at least have to be paying quarterly. Well, how do they know, when you earn the income? That means you've got to pay in enough taxes through withholdings. Well, this rollover strategy is you get near the end of the year, so get into the fourth quarter and do a tax projection. You do basically a mock tax return. What source of income did we have this year? How much do we withdraw from our IRA? How much interest do we think we're earning on our savings accounts? All that sort of stuff. You build a mock tax return and you take a look and say, well, how much extra withholding do we need? Oh, well, we need $3,000 of extra withholding. Okay, let's take $3,000 out of our IRA and send it 100% to tax withholdings. If you do that, that will be deemed by the IRS to be taxes paid when earned. And so it kind of satisfies that qualification, that requirement, and you don't need to do quarterly estimates. But you might say, but wait a second, if I draw $3,000 out of my IRA and send it to the IRS, now that $3,000 is going to be taxable on my return, causing more taxes to be due. I've just sort of created this circular problem. No. You take the cash that maybe you had somewhere else and you put $3,000 back into your IRA, and that neutralizes that or offsets that $3,000 from being taxable, and now it's actually a rollover, not taxable. And you might say, well, wait a second, if you've got the $3,000, just pay that in a tax estimate. I know, but that's got to be paid every single quarter. And a lot of times people forget or pay those late or get frustrated with those. Therefore, this meets the requirement from the IRS that the taxes are paid timely as you earn the income, but it avoids having to fill out the W-4P, and hopefully they get it right, and it avoids needing to do quarterly estimates. The big picture is I want you to avoid tax surprises. How do you do that? Proper tax planning. Tax planning is one of the 6 areas of your financial life, my financial life, everyone's financial life, and you need to be planning proactively for your taxes to optimize opportunities, but also to avoid surprises. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com, that's Korhorn with K. WiseMoneyShow.com, you can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.